Might just ask you to check your phones are on silent, please. Thanks. Although phones technically are digital media, so. Okay, you're very, very welcome today. I'm Damien Ryan. I'm a partner in the corporate finance team at Moore Stephens. You're very welcome, as I said, to the Soho Hotel, which is quite difficult to say, Soho Hotel. And also welcome to anybody who's joining us online on our streaming. So why have we brought us all here together today? Really to share knowledge. At Moore Stephens, we've got a very active corporate finance team, and part of our own due diligence in the years ahead, particularly 2018, is where are we going to point the needle? Where are investors going to want to place their bets? What types of businesses are going to be coming to the market? Who's going to be buying what? Who's going to be selling what? All these kind of things. So what better way, as part of our own DD or due diligence, than to share this knowledge with all of you here today. So we have representatives from not just brands and advertisers, but from the supply side as well. And importantly, when we talk about digital, because everything these days is digital, has some sort of digital component, we are referring to media, entertainment and communications industries and the support services and technologies that drive that. So that's the background to the event today. Of course, it's very exciting times, not just in the UK, but worldwide as well. London is still the European media powerhouse. The UK is still, from an internet standpoint, the biggest internet advertising market in Europe. I haven't quite caught up with Mr. Hammond's announcements today, but there's some very big numbers being put into AI and technology. It's £500 million gone in today, and a further £2.5 billion being invested into what I guess will be the British Business Bank, perhaps to prop up some of the changes to the local VC industry. And we have some VCs here today who will, I'm sure, want to talk more about this. One interesting observation from Moore Stephens is that based on our research and based on our conversations with growth capital companies, that we believe that more companies in Britain will be coming to the market to seek growth capital in the 12 months ahead than we have ever seen before. So that's quite an exciting time to be in corporate finance. Further afield, digital continues to make the headlines. Just yesterday, Tencent in China pipped Alibaba to be China's first $500 billion valued company. I'm not sure how many zeros are in there. I'm not an accountant, but I know where to get one. We're also mindful of AT&T and Time Warner and the Department of Justice putting a block on that merger, which throws up all kinds of questions about the clash between media ownership and communications. What it'll mean for Comcast and NBC is interesting, because I think that was really the same kind of deal at a different time. GDPR, the acronym that's on everybody's mind around Europe at the moment, but does GDPR go far enough? Shouldn't data be something that should be part of cross-border deals instead of actually trying to silo it? It seems to me that perhaps GDPR may have missed a trick. For our speakers today, we're very fortunate to have a broad range of speakers from the various groups of stakeholders. Later on, we'll be joined by Charlie Ardar from Facebook, Declan from Web Summit. He's fresh back from an event in Portugal earlier this month where there must have been, I think there were 60,000 people turned up. But Declan Kelly from Web Summit, who's been working closely with investors for many years, will be able to share his thoughts with you. And on his panel, we have David Fisher from Edge and Karen McCormick from Beringea, two very well established and respected VCs and investors from the London industry. Russ Shaw joins us. Russ is the man with his finger on the pulse. He has managed to capture the technology zeitgeist in London and is now going global. It's quite extraordinary how much Russ seems to move and shake in various tech markets around the world. But it's great to have Russ here today. He'll be joined by a brand, Pernod Ricard, and a Martech player, AdYouLike, for Lovell is joining us from there, and also in front of me, Nick Hirst from adam&eveDDB. So that's the agency, the brand, and the technology provider getting together later on today. But first, I'll be joined by Josh from Sarasin Partners. I'll let Josh do his own introduction, but needless to say, I think that the expression ad tech has come in for a bit of a bad rap, really, from analysts over the last 10 years. And we have seen quite a shift towards Martech. Now, is that just perhaps rearranging the deck chairs on the Titanic, going from ad tech to Martech, or is there something more at play here? And Josh will be able to give you, as somebody who's managing $20 billion of investments in this space, he'll be able to give you the helicopter view of this. And then I forgot to say, so please forgive me, but in the middle of all this, we'll be looking at an initiative undertaken by Moore Stephens earlier this year with our friends at WARC, where we have become, happily, I'm very proud to say, we've become the first firm in the world to market size the Martech market, because we think it's going to be a very, very interesting space. So there we go. One of the objectives I'd like to think about from today is that together we can share our thoughts on what are going to be the hot areas for investors and for stakeholders in the year ahead. And also let's think about what are the not so hot areas. Who's gone past their sell-by date? Let's find out. Thank you again, and I'm going to hand over now to Josh, who's going to kick this off and give you the helicopter view from the fund side. Thank you very much indeed. And you can clap.
Thanks, Josh. Thank you. Okay, well, good afternoon, ladies and gentlemen. My name's Josh Sambrook-Smith. I work for a company called Sarasin Partners. We're a global investment management organisation. We manage $20 billion across a range of institutional, retail and charities mandates, all of which is invested in the listed equity markets. We're long-term investors, so we invest in stocks between 3 to 10 years, and the minimum investment size is between $2 to $3 million, and it goes up to $400 million, so broad range of sizes. We're heavily invested in the technology space, so across digital media, semiconductors, data centers, enterprise SaaS, ad tech. We have a broad range of investments across the funds. Damien asked me to come in and talk a little bit about how a capital markets investor looks at the digital sector, and in particular marketing tech. What are our high-level views on it? What do we think the strengths and weaknesses are, the opportunities? Just how do we think about it? And I think straight off the bat, it couldn't be a more exciting time to be investing in digital. When you think there's been an explosion in processing power, an explosion in data, connectivity, all these things, they've created a platform for just an absolutely phenomenal amount of innovation. And you can see a load of these different technologies up there at the moment, but they've all come together to change consumer behavior. So to change the way people interact with technology, to change the way they interact with content. And it's created an enormous number of commercial opportunities. And I've only got 20 minutes, not 5 hours, and I'd love to talk about all of these different technologies at once, but I can't. So what do we think about marketing tech in particular? Well, the first point to make really is just that there is a phenomenal amount of innovation going on here. There are thousands of companies, they're creating hundreds of different technologies. There's just a huge amount of creativity going on. But to an outsider, that really is a bewildering array of different technologies, and it actually can be quite difficult to come in and understand how they're all weaved together so they can be used to go out and get the next big opportunity. I mean, so how do we conceptualize it? What's the right way to look at it? Well, we think this idea is slowly crystallizing in the market's collective consciousness that marketing tech is really a data-driven way of driving your customer down the marketing funnel, so hand-holding them through the customer journey. So hitting them at the right time with the right message across channels, and essentially driving sales. So, and then eventually using that data-driven approach to lock your customers into your own feedback loop, drive longer-term loyalty, create longer-term value. And we think that the more use cases and the more proof points that we see of that happening at very large scale, then the more pervasive that idea becomes that Martech is really the next $100 billion opportunity. It will take time, but we're getting there. So what do we think about the stock market? What's going on there? Well, rightly or wrongly, we've divided the camp into two buckets, so ad tech and marketing tech. I know it's highly contentious. You can come and have a go at me later for it. But if we just look at a basket of ad tech stocks and how they performed over the last 4 years, well, not really very well. So they got off to a good start in 2013, and then they dipped, and they've been weak ever since. And the reason really is that after the euphoria subsided, issues with viewability, issues with ad fraud started to rise to the fore. And then people began to question the business models. So does a percentage of media spend model really work? Why is there no revenue visibility? All these things. And then you sprinkle over on top just good old-fashioned complete lack of understanding from the capital markets, and you've got the recipe for underperformance. And I'm definitely not trying to say these are bad companies, but they are misunderstood by the market, and they've had their own fair share of challenges. If we look at marketing tech, though, and how that's performed over the last 4 years, so that's performed astonishingly well, so 300% since January 2013. And the first thing to point out there, from our perspective, is just the business model. So a lot of them are SaaS companies. They have predictable revenue streams. There's a stability in the cash flows. The economics of SaaS is quite well understood by the market. So small upfront investments, payback within 1 to 3 years, and then an annuity stream of revenue after that. You layer in the fact that the fundamentals have been extremely strong, so the demand environment is crystallizing all over the world for these sorts of businesses, and the fact that they have absolutely stunning competitive positions. So they're building platforms, they have thousands of customers, they're growing, everything's looking pretty good, and that basket's done pretty well. And no talk about digital would be complete without a comment on what's going on with the large cap names. So Facebook and Google continue storming, even despite their size, so a $500 billion and a $700 billion company. But the real outlier there has been Tencent, so the Chinese social media company. And there's a few things going on there. I mean, one is just the market gets that these companies do mobile properly, which may sound ridiculous to everyone in the room, but to capital markets investors, it's actually quite a novelty. So the market understands that finally. People see video as the next big opportunity for these guys. People understand the broader advertising growth opportunity that they have. So there's a lot to like about these businesses. And that's not, notwithstanding things like their insanely good technology platforms, the monopoly they have on time spend, etc. Lots to talk about there. So another question we quite often get is what's going on at the higher level, so the technology industry as a whole. So we look at something for something called the MSCI Information Services Index, and that is a basket of all the listed technology businesses in the world. And that's just its price performance over the last 22 years. And the first thing to point out is that that basket is back to the levels it was at during the dot-com boom. So prices have rocketed since 2009, and you can attribute that to a few things. One is just low rates. Another is investor flow, so there's more retail investors in the market than there have ever been. And there's a lot of momentum. But if you look at it on a price-earnings ratio, just a simple valuation measure, so market cap divided by net income, it's a very basic earnings measure. It's not as expensive as it was during the dot-com boom. So this is just large cap companies, remember. These are big businesses. It peaked at 50 during the boom, and at the moment it's just under 17. What's really spooked people, though, is really what's happened here. So the market's re-rated from 10 times up to 17. It's causing an enormous amount of consternation in the equity markets. And the message is tech overvalued? Is this market going to blow up soon? What's going on? There's a lot of debate there. So the question is, well, what could unseat it? And when the market's advanced the way it has, I mean, literally anything could. So an errant tweet, America invading Korea, China financial market blowing up, there could be anything. But we try and isolate it to a few relevant things. Obviously, the GDPR is one that we focus on enormously, so the European General Data Protection Regulation. And really what the market's doing at the moment is just trying to get its arms around what it means for all of our listed companies. What does it mean for Facebook and AdTech? What does it mean for data sharing, consent, all these sorts of things? And at the moment, there's no conclusion. People are trying to understand what it means. Brexit is a debatable one. Whether it really affects innovation in the UK is, well, it probably won't. Valuations, I mean, we've just spoken about that. The market's a bit peaky. And then competition is just the perennial concern for any technology investor. When you think digital market entry barriers are low, there are thousands of companies popping in and out of existence all the time. It's not surprising that we focus so much on competition. Who could be the next company to unseat Facebook? Who could blow up Salesforce? It is the sort of constant debate in the office. So I've spoken about perceptions and just broadly how we think about ad tech and about what's going on in the equity markets. But what's the industrial narrative? So what's the story we use to articulate what's going on from the high level that we do look at things? Well, the first thing is what's happening in digital advertising. So digital advertising, global digital ad spend hit $200 billion this year. It will reach parity with traditional ad spending by 2021. So it's been on an absolute tear and it will continue for a few years. And essentially ad dollars are just following audiences online. So as people spend more time online, ad buyers are just allocating more of their budgets to digital media. And then the other thing we think is that advertising spend as a whole, the long-term view there, is that it will probably over-index to digital. So it will be more ad spend for time spent. And that's simply because of the return profile of that medium. You can get much better returns, it's much more measurable, there's a lot more to like about it than you can do with traditional forms of advertising. We look closely at publishers as well. So the market for publishers has been a very difficult one. So traditional revenues, print revenues have been declining, and they've sought refuge in the online space as their audience have followed. But the problem is the economics of online are just not the same as buying traditional media. There are hundreds more intermediaries in the chain. There are more mouths to feed. $1 spent on online advertising, on average, not generally, but on average, is about 30 cents of revenue to a publisher. So the economics are completely different. It puts pressure on the publishers. It probably means the ad tech space is right for consolidation. But that causes a lot of debate, and that's an interesting space. What is super interesting, though, is what's going on with Facebook and Google. So that chart is just showing you the share of incremental ad spend, digital ad spend, that those two entities are taking. This year, they'll take over 100%, and that just means that the market is growing. They're bringing on lots more smaller advertisers who are dipping into their budget and spending on digital advertising where they've never done it before. And they're also taking share from traditional digital publishers. So a lot of the money is going to just two players. And again, that's a testament to their ad tech platforms. But the real thing that we look at is just the returns. So any digital agency that you speak to, most digital agencies that we speak to, the message usually is that the return profile of your digital spend is just much higher on those platforms than it is for other forms of online spending. And in many respects, it's better than what you can get on traditional. So digital has been, bad is probably the wrong word, but it's put the agencies, the ad agencies, under pressure. So that chart's just showing you their share of global advertising spend over the last few years, and clearly that's come down. So the global market has grown. They've not been very quick to react in digital. They kind of dropped the baton there, and they've been challenged. And if you look at a stock price performance of the global ad agency stocks, say think WPP, Publicis, IPG, Omnicom, etc., it suffered in 2017 rather, so off 25%. And the rationale there is that, well, there's two reasons actually. So one is it's Amazon. So the Amazon Death Star has entered the market for their retail customers. Consumer packaged goods businesses, retailers in particular, are really feeling the burn, and they're cutting their ad spend as a result, and that's hurting the digital agencies because these are big industries which are being affected by Amazon. So Amazon has been a big problem for them, but also there's this idea that, and it's slowly beginning to crystallize, that digital is going to be a genuine disintermediating force to the old school ad agencies. And it's not really hard to see where this comes from, this idea that digital is disintermediating the ad companies, or the ad agencies. If you look at a list of the top 20 ad agencies by revenue, 10 years ago, that would have just been ad agencies on that list. But today, you're increasingly seeing technology companies feature heavily on that list. So marketing, advertising, etc., is just way more tech intensive than it's ever been. And while that's going on, while that increasing reliance on technology is building, in the enterprise space, things are changing enormously. So if you think about the old enterprise stack, in the past you would buy a huge product from SAP and it would have all these different verticals but bundled into one product. Well, cloud is blowing up the enterprise stack. There's been hundreds of software as a service companies coming onto the market over the last 10 years that have been completely unbundling this old on-premise perpetual model. And it's obvious really who the winners are. So there's a handful of significant companies that are emerging as winners in this space. So Salesforce, obviously, in CRM, Workday in human resources, ServiceNow in IT and operations. But the interesting thing here, though, is if we look at the marketing vertical, Well, it's actually still really heavily contested. So that's just a list of 5 companies. I only put them up because they were interesting. If you look at the Gartner Magic Quadrants, there's tens of companies. If you look at the Lumascapes, there's hundreds of companies. If you look at Scott Brinker's Lumascapes, there's thousands of companies competing in the space. So it's heavily contested. There's a lot going on there. And one of the reasons is that companies from all sorts of different verticals are just ploughing into this area. So large corporates with data assets are looking to buy up smaller technology assets to leverage their own capabilities. So to build bespoke solutions, to buy assets that they can use to leverage their own capabilities. But the one common denominator there, though, is data. Everyone with a data repository, doesn't matter how fragmented, they're pushing into this space because they think they can use it. So we've seen VC money flooding in there, private equity money, and a load of corporate buying going on in the space. And there's a lot of stuff to buy, actually. So that's Scott Brinker's Lumascape equivalent. So 5,000 companies on there. The first thing to note is that it's clearly fragmented. It's enormously complicated. And it creates a lot of issues for listed market investors, because the first thing we ask is, well, which one of these companies is going to unseat Salesforce? Who's going to blow up Adobe? What would be the next $10, $100 billion company coming off this cohort? Who's going to form the next wave of IPOs? It's a lot of food for thought. But what we are left with, though, is that idea that there is a tremendous amount of innovation and growth going on in the space. When we try and think about the immediate demand environment for marketing tech in particular, the first point to make really is that if we base that thinking on the survey work that Gartner and Forrester have done, the survey work we've done internally, the hundreds of conversations with CMOs and CTOs that we've had over the last 5 years, the messaging there is really that marketing tech as a technology is actually quite underrepresented in a lot of enterprise. They don't use it as much as they could do. And many of those technologies are barely used at all yet. But when you ask, of course, well, what are your buying intentions? What are your purchase intentions over the next 3 to 5 years? And you take that information from the same surveys, from the same anecdotal conversations that we've had, the messaging there is that on any large organisation's 10-year strategic IT roadmap, and everyone's got one, that this technology features prominently on there. So there is a very strong purchase intent to buy more of this stuff inside the enterprise. And obviously that gets us excited as listed markets investors, because we know there's a long demand pipeline for it. Oops, that was an early reveal. When we look at marketing tech, what we're thinking really is that this technology sits at the nexus of 2 of the largest megatrends of our generation, or my generation, cloud computing and digital advertising spend. And when we try and conceptualize that in financial terms, I mean, what we're really saying is that it sits at the intersection of $500 billion of IT spend and $500 billion of advertising spend. So it sits in the middle of those. There's a wall of money moving in the direction of that technology. Now, we've gone through the survey work that WARC and Moore Stephens have done, and we agree with that number, actually. So $36 billion, completely legitimate. We agree. We also agree it's a 10% growth rate this year. But when we try and look even further out and we start to layer in more thinking to that, so we start to say, okay, fine, what's going on in the emerging markets? If we look at the 10-year IT strategic roadmaps that a lot of the large cap organisations we follow have, we look at the changing budget priorities inside IT, you can get to a much larger, longer-term addressable market. So the total potential, we think, for marketing tech at the moment, based on the work we've done, is nearer $70 billion. So it tells us that 36 billion has significant headroom to grow over the next few years. And that's one of the reasons why we're so interested in this exciting sector at the moment. Thank you very much.
Thank you, Josh. Just a quick question. Your 70 billion, was that worldwide or global? Okay. That stacks up for us as well. I'm going to invite Declan from Web Summit and David and Karen to grab a chair over here. And this panel is really getting down to it. So what's getting your attention right now as investors, and where will you be placing your bets in 2018? So we have Karen McCormick from Beringea, David Fisher from Edge Investments, and Caroline Macintosh from Pernod is on the wrong panel. But there we go. Okay. Good news from Philip Hammond about drink, though, in the budget. I think that most of your products are staying without a price hike. Yeah. Okay, so Declan, over to you. Thank you very much.
Sweet, thanks very much. So my name is Declan Kelly, and I head up the investor team for Web Summit, which runs the technology conference in Europe. We also do them in Asia and the US. I'm delighted to be joined here with both David and Karen. So I suppose to begin, I'll just pass it over to you guys to talk a bit about just your background and your specific funds and the investment thesis of those funds. So if you could just briefly describe your overall fund and investment thesis.
Thanks. David Fisher from Edge Investments. Bit about my background. I've been in venture capital since 2000, just in time for the peak of that chart that you put up there. So, but I agree that the valuations are back up, but probably much better companies underlying it in the capital markets. So I've been in venture capital 17 years. I've been at Edge 10 years. We are a specialist creative industry sector VC fund, which is reasonably unique, not absolutely. We invest in businesses that we say have generated their core intellectual property. Falls into two different categories. One is content. So we will invest in whether it's gaming, television, perhaps catalogues of film, music, traditional media content. One of my lines is no one watches ITV or Netflix, they watch the content that are on those platforms. So we believe in the value of content, and the UK in television production, for example, has a unique element to it around terms of trade where they retain the rights so they have value. We all remember the value of Bake Off when it left to BBC. So we will invest in traditional media assets and media businesses. The other sort of IP that we want to back is technology, but technology only where it touches the media and entertainment and creative industries. So it generates, it distributes, it monetizes, it curates, anything in that world. We have raised about 200 million. Our current main fund is 40 million, where we are backed by the British Business Bank, as has been mentioned already, because they have got all the money. And we invest 1 to 5 million in businesses which have certain revenues and, as I said, develop their core IP. So we're quite specialist in that sector.
I'm Karen McCormick from Beringea. We are a $675 million venture capital fund with offices in the US and the UK. We have been around for about 30 years, and we're a generalist investor, but media is a very strong part of our heritage. I'd say within the UK portfolio of 42 companies, I think we have 3 that are pretty squarely traditional ad tech sorts of businesses, and then probably another 6 or 7 that would fall into kind of the Martech category. We, in terms of our investment thesis, we play in kind of late stage venture capital or early stage growth capital. And for us, what that means is we're looking for businesses that can get to profit off the back of our investment or our syndicate of investors. So about half of our portfolio is currently profitable. At the time we invest in businesses, they generally turn over somewhere between 1 and 20 million, and we write checks of about 1 to 20 million. And by the time we exit, we make good returns out of businesses that we can sell for 50 to 500 million. So we aren't necessarily unicorn hunters, and we'll probably miss Facebook and Google, because what we are looking for are businesses that can get to self-sustaining as opposed to being constantly dependent on the next check for further funding. So that's sort of where we sit in terms of the investing world.
Cool, perfect. I'll keep with you for now, but I suppose I'd be intrigued to hear your thoughts on how you feel the Martech sector will play out over the next year, and kind of any key challenges that startups are facing within that or the ad tech sector.
It's a good question, and I guess my first question would be, what is Martech? What is Martech and what is ad tech? And I think when Josh put the slides up, most of the things that were classified as Martech tended to be platform software businesses. And in my own mind, the way that I think about it, and the way I think a lot of investors think about it, is ad tech tends to be, if your revenues are dependent on advertising spend, you're an ad tech company. Almost anything else could probably be Martech. And right now, I mean, to Damien's point earlier, it's a confusing market for investors, in part because I agree wholeheartedly with Josh's view that a lot of investors didn't know what they're doing. And this is true of any nascent market, not just ad tech. But there's a euphoria about the market, lots of money rushes in, people start seeing valuations go up and everybody loves it, and then they start learning about what they invested in. And the euphoria slows down, and then people start questioning what they have. And within ad tech, it's so much more difficult because there are a million moving pieces, and it's usually very deep technology that's hard to really diligence or hard to compare to the rest of the market. How do you know that your location-based solution is genuinely 80 times better than the 5,000 other people on the Lumascape? And I think for investors, that's really hard to diligence and understand. I think on the Martech side, if you were to classify Martech more as businesses that are getting their revenues from marketing initiatives that are not advertising spend, which I think would be more of the software platforms, or kind of, we have a business called Smart Assistant in the portfolio, which does kind of guided shopping, or we have a business called POC in the portfolio, which is basically, it's an app commerce business, and think of it as Magento for apps. I think for those businesses, it's a lot easier to diligence because you're using the product and you know if it works. You can diligence it through the customers. Whereas even if you go to an agency and say, who is your best provider of X, the agency will give you 30 or 40 different answers, and it probably depends on who has the best heat maps and products that they can send back to their clients to show what a good job they're doing. So I think in terms of kind of future, ad tech has become a dirty word, and for kind of reasonable reasons, which doesn't mean there aren't great businesses there. I think it means for ad tech businesses going forward, part of the challenge is to be able to articulate what you do really quickly, really simply, and think about pitching it the way that you would pitch to a client, in that these days, every client wants to know, is it auditable, is it diligenceable, how can I see the results against the competitors? And I think that makes for an interesting case. Most investors are now really looking for revenues and profit as well. And by revenues, our experience in the US right now is if you don't have at least $100 million in revenue, most investors aren't interested. And I think part of that is driven by it's a proof point. They can see that you are a really durable business, you've been here for a long time, you've got significant revenues, and then you also have to have profit. So I think if you think about that being kind of the requirement, especially in the US right now, I think what we're likely to see is a whole lot of consolidation, because those 5,000 people on the Lumascape are going to have to consolidate until they've gotten to that sort of size and space. On this sort of Martech, if you think about that as more anything that isn't directly derived from advertising spend, I think it's in a reasonably good place, and I think there is a significant amount of growth for that for those sorts of businesses, in part because the big incumbents, the ERP suppliers, haven't moved very quickly to try and address kind of the new channels and the new ways people shop and buy. So I think there is the future of Martech. I think is solid. I think if you are squarely in the ad tech space, which again I'd classify as revenues derived from advertising spend, it's a challenging time to raise money and a challenging time to sell.
Yeah, and I suppose with that in mind, so many Martech companies are finding it particularly difficult to raise money, irregardless of how they spin it, whether they're artificial intelligence or machine learning. So kind of what advice would you have for Martech founders looking to raise money currently?
Yeah, I mean, if it's, I guess just going back to I think what I'd classify a lot of what you're talking about is as kind of traditional ad tech businesses, and everybody's trying to rebrand themselves as an AI machine learning business if you're in the ad tech space. And I mean, if you think about walking around Mobile World Congress, I'm guessing, has anybody been to Mobile World Congress? So you walk around, especially in the startups area, and I'm reasonably informed investor in this space. I wouldn't say I'm an absolute expert, but I walk around, and unless I spend more than 45 minutes at a stand, I cannot tell what one stand does versus the next stand versus the next stand versus the next stand. So if you're thinking about raising money, I think I'd go back to that. Make your pitch. It's got to be one line that explains exactly what you do, why it's valuable versus the market, and how you can diligence it. So I'll try to think of an on-the-fly example, and I'll do a terrible job. But rather than saying we're a location-based advertising company that processes X billion impressions per second, think about saying we are a location-based advertising company with a proprietary network of 50,000 beacon technologies installed in U.S. shopping malls, which is 5 times as big as the next competitor. So something that says right away, this is what we do, this is why it's better, and this is how you can diligence it, and this is what we own that's different than everybody else. If you can't do that really concisely, I'd question what your messaging is. And of course, your business is going to do 5,000 things outside of that, but you need to boil it down to really simple for an investor and make sure that they can diligence it. And I think if you're at the beginning of a journey and kind of starting a business, if the business requires significant capital in the early stages, and you're in a sector where you're dependent on advertising spend, I would question the viability of that model. If you're going to try and get a business like that off the ground, you need minimal investment to begin with until you've got a real proven track record and a decent amount of size.
Perfect. And David, where do you think the key challenges exist for companies within the digital media sector?
What we try and find when we invest is some market discontinuity. Because I think if you're trying to work in a market today, which is dominated by some of the big platforms, massive companies, you've got to look for something that's changing, something that's different. Being a player in a market, a linear market that hasn't got any drivers, any change. So to give you two examples, we're looking at a business at the moment that absolutely says it's going to benefit from GDPR for various reasons about how it goes to market as a Martech player, an AdTech player. We've got another business we've invested in called Myriad, which is about putting brand into content at the point of broadcast, not in an interstitial ad break in television and content. So something that is about user, consumer change in performance in how they access the content, access the information, rather than just saying we do, as you've said, we do the same thing but slightly better than the other people. It just doesn't, you can't diligence it, you can't understand it. So something that's a fundamental change in the market, and for us where they've developed the core IP and they've proven that with just our amount of money, which is 1 to 5 million, so it's not the huge funding rounds that are going on, you can get to a plateau where there is profitability. But just going into a market where we do something 1% faster, 1% better than the 1,000 other companies is of no interest. They need to position themselves that there's a fundamental change in the market that they can benefit from. Because as sure as eggs, we always say, humorous line, can Google do it? Well, of course Google can do it, or Facebook, or any of the guys with $200 billion cash piles. But it's about that you're a first mover in a market because you've seen a discontinuity in the market and you're targeting it.
Cool. And within that sector, are there any kind of companies that stand out, or what type of companies are really grabbing your attention right now?
Well, as I've said, if there are changes in the marketplace, that they are identifying them perhaps before anyone else does. So whether it's different forms of viewing, different forms of consuming content, whether it's mobile plays, anything that is changing the environment, and they are part of that, and they have spotted a discontinuity in that world. But yeah.
Cool. So Karen, I'll go back to you here. So traditionally the quote has been that software is eating the world, but is AI currently a bigger threat? What companies do you think are using AI well at the minute?
Oh, that's a challenging one to answer on the fly. Like everything that's the next big thing, everybody who comes to see us now has an AI solution. And usually AI means a guy with a spreadsheet. And that's okay. That's okay. I do think AI is going to be genuinely significant, and I think it's going to happen faster than we think it is. Yeah. And I would say the place I think it's where it's going to happen faster than anywhere else is probably self-driving cars. There's going to be a day when it's illegal and unthinkable that humans were driving cars because the safety records are just going to be so different. And I think that's going to be pretty quick. So I think in the automotive industry, they're really driving AI, and they have to actually use AI rather than talk about it or have a guy with a spreadsheet. So I think to make it a bit more relevant, if you're going to talk to an investor, one of the things that everybody's skeptical of right now is if you come in with your AI or your machine learning solution. So what's better is to actually explain what your software does and let us realize that you're using an AI solution. And you don't have to be. I mean, it's good to be thinking about AI strategy and how AI is going to affect your industry and your company over the medium term and even the short term. But to come in and say we've got a great AI and machine learning that's the same spreadsheet you've been using 3 or 4 years ago, people are going to see through that quickly and start to get skeptical about the business. So I think you do have to have how is AI going to influence my industry and my sector, and understand where it's going to take you. And if you genuinely have a solution, if you just start showing that solution, we'll get it right away. But I do think, I mean, outside of automotive, I think the consumer industry is starting to pick it up in quite interesting ways. And it's early and it's nascent, but there's a lot of data. And it's the industries where there's a lot of data where AI can actually take off first. And within the consumer industry and within the advertising industry, a lot of data exists. So I think people are doing it. And I think Google is, from what I've seen, I think Google has some capabilities and capacities. I haven't yet seen it applied in really interesting, practical ways yet.
I'd agree, and but I think the companies I've seen in AI in financial services, which is not our sector, are probably the leading ones. And I think as that washes out, real AI or machine learning, it'll affect our sector, the creative industries and Martech and AdTech. But I think they'll be the ones that lead. After all, why do you rob banks? Because that's where they keep the money.
Cool. So I know both of you are venture capitalists, but do you think that VC is the best funding source for media? So recently we've seen the likes of Mashable sold for 50 million, whereas not long before they were valued at over 250 million.
Yes, VC is the best source of capital. But actually, no, it isn't. It needs to be the right source of capital for your business at the right time. VC, in many ways, is expensive, and by expensive, I mean the returns that VC require from each investment are very high. You need to grow very quickly. You need to use that investment very efficiently, and give a return on investment that you've got to be prepared to take on at the beginning. The sources of capital in the UK, saw the doubling of EIS and VCT this afternoon, so your funds will be happy, use the right source of funding at the right time for your business. SEIS, EIS, Series A, whatever that is, and that's massively increasing in size. Our biggest investor, the British Business Bank, gave us some stats that the average or mean, I can't remember which it was, Series A in the UK now is over 6 million, and rising rapidly, nowhere near US levels yet. So get the right source of capital for your business at the right time, and understand the requirements. The corporate ventures are coming in, but understand if you take corporate venture money, you're closing off a lot of your exit routes. So venture capital is extremely useful for a business that knows it can grow and can use that capital efficiently. It's not if you can't deliver on your numbers, because it's going to get very painful very quickly.
Yeah, I think I'd echo a lot of what David just said. I think it's worth understanding, because venture capital means a lot of different things, and venture capital in the Valley is very different than venture capital in the rest of the world, let alone the rest of the US. So I think, talking about your example of Mashable, a down round, by definition, traditional VC is a 2 pays for kind of 10 model. So you expect sort of 70 to 80% to go bust, and the 20% that don't to pay for the fund a couple times over. That's sort of traditional venture capital and what the Valley generally still looks for. It's why they push really hard for take a bigger check but grow a whole lot faster than you planned on growing. And that's the model. So by definition, people talk about the dreaded down round. By definition, 80% are going to have not only a down round, but a 0 round, because your valuation is going to go from whatever it was when you came in to being written off. I think that's kind of a Valley model. And if you are a highly aggressive entrepreneur with huge ambitions and you're happy to be pushed to grow at 300 to 500% per year, then that is probably exactly the right kind of profile for you. I think in the UK and the rest of the world, it's not quite as aggressive. There's an expectation that most of the companies will probably at least get the money back. Some will be written off, and then some will have good returns. So for somebody like us, we can be happy with a company growing at somewhere between 30 and 200% a year versus kind of the 500% per year you would need to return the funds in a West Coast VC style sort of investment. So I think to answer your question, a really long-winded way of saying it really depends on the kind of investor and what they need for their returns.
Cool. So David, I think the next one is more relevant for you. So how do you think technologies like AI and IoT will change the day-to-day experience of entertainment going forward?
Easy one. When we were pitching to raise our fund, the business bank gets an awful lot of tech investors approaching them. And they were saying to us, I said about our strategy investing in content and in technology. And they said, more content, please. And we said, well, look, let's go back to the gramophone. Content is technology. Content is driven by technology. You do not consume content outside of maybe the odd live event, but who doesn't use one of these when you're consuming content? So the content consumption and technology are one and the same, especially today, one and the same. So the continuation of that technological advancement and new platforms and new opportunities to consume content is two things. One, offers great opportunities to invest in some of that technology, but also where we come back to is we believe in the value of content, because people consume the content, they consume the music, they consume the games, they consume the live event. on different platforms and different technologies, admittedly, and that's why we think that this symbiosis of the content and the technology, what we're about, whether Internet of Things, whether it's increasing mobile, whether it's any of the AI technologies, spreadsheets, yes is the answer. All of those things will play a part in how people consume technology. But again, as I said, we believe that the content side is equally as important as the technology.
Cool, perfect. So given that you're both investors in Europe, I'd just kind of like to get your thoughts on the overall European scene. So what do you see as kind of the main barrier for growth in Europe's tech scene? Do you think it's funding, the language, regulations? So Karen, you've worked in both the US and Europe. What do you think is the main kind of barrier to the growth of the Europe scene?
I think there aren't a lot of barriers at this point. I mean, I think the funding, and I've been doing this job for 10 years, and before that I was working with startups and early stage companies, but the scene in Europe is just so different than it was, forget 10 years ago, even 5 years ago, in terms of the support ecosystem, the entrepreneurs groups, the conferences, the capital available, and the check sizes. I mean, to David's point, not only our check size, but our syndicate of check sizes over the past 10 years is just completely different. It's probably 7-8 times what it was 10 years ago. So I don't think there are a lot of barriers. I mean, I think one thing that will always hold true, if all else was equal and the market was exactly equally competitive and deals were equally priced and there was as much capital in both markets, you're probably better off spending £1 on a company in the US because it's easier to scale there, just because we don't have multiple languages, multiple geographies, multiple legal legislations. Don't ever underestimate the complexity of going from one state to another, but it's not as complex as going from one country to another. So if all things were equal, you'd probably get a better return putting £1 in a market that's more scalable. But it's not all equal, and the US is hyper competitive, and deals are overvalued there right now, even more so than in Europe. And so I think there's a lot of appetite even from US investors to invest in Europe. So I'm not sure there are big barriers.
Absolutely agree. I was on a panel with one of your colleagues last week, actually, and I used the phrase that London, at least, is awash with money. Absolutely awash with money, whether it's SEIS, EIS, VCTs now doing, as you've been doing for years, real venture rather than fake buyouts. British Business Bank backing great funds like ours. Corporate ventures coming in, US VCs coming back in. It is awash with money. Valuations are going through the roof. Round sizes are going up. I don't think there are any barriers, you may not feel like it if you're trying to raise money, any barriers to raising sensible amounts of venture capital of SEIS, EIS, VCT, VC money. It's huge amounts of money, and that is a massive change, huge change, whether it's because returns, stock market pricing, whatever it might be, interest rates. There's a lot of money looking into alternative asset classes, and VC early stage funding is one of them. We think, interestingly, a lot of the businesses that we see, I don't think Europe's necessarily becoming the flyover states, but they want to go to the States and they want to go to China. So 2 of our businesses at the moment, our CEO just did a road trip to China, meeting all of the major players we all know, Tencent, etc. out there. And 2 of our businesses now are doing major deals with those platform businesses in China, one from the content side and one from a tech side. Really not trying to do them in Italy. So we are perhaps parochial in that we invest in the UK. We can look at businesses outside of it. Really, we're not going to do that. But they go to America and they're increasingly going to China. So it's not seeing any barriers to their growth, and we're very happy funding those trips and the business they're trying to do out there.
Sweet, that's good to hear. So I'll finish up just by asking you each kind of what key trends are you each looking out for across 2018?
We think, I was having a debate earlier, that GDPR is going to offer some opportunities. I think it's going to shake up a lot of businesses that are on the multi-thousand map up there, and we're looking for those discontinuities around what that change can mean. We've seen some conversations say not a lot, and others that say fundamental destruction of business models. and people are going to be massively fined and go to prison. So we're looking at businesses there. I'm going to steal a GP Bullhound line. Sorry to talk about the opposition. Where they're not looking for unicorns anymore, but they're still looking for animals, and they're looking for rabbits. Real, actual businesses building interesting tech. And if you look at the weighted capital, is not going into the massive consumer platform businesses, the pizza delivery and type companies. It's going back into technology, whether it's into Martech, whether it's into AdTech, back into the, I don't think I've seen a slide with ERP written on it for quite a few years. But it's definitely going back into that technology, and we're following that. We like platform businesses, so our most recent investment is a business called TRX, the Rights Exchange. That's a platform for the sale of secondary rights. Why? Because it stops people getting on planes to Cannes and doing a deal for 500 quid when they should be doing it on a trading platform. And shortly after we invested, the BBC put on 9,500 of its shows onto the platform to sell. So we like those scalable platform businesses that are enabling, being rabbits, and enabling traditional business processes to be put onto a software platform, which is basically what software and technology has always done best. So those are the sort of plays, those are the sort of businesses that we would be looking for going forward.
Every year we go through a process of strategically mapping out the areas that we think are going to be interesting and the areas we want to invest in, and it always comes back to the management teams. When we meet a great management team that we really trust, we really believe in, and we want to back, we tend to do it regardless of what our strategic sector analysis said. But I do think, areas that we spend time in always are digital media, business software and services, and consumer, which for us means anything from actual physical goods to data analytics businesses selling into the consumer industry. And those are three sectors we'll continue to look at. I think cybersecurity is becoming an area that's more investable for us at this point, because there are companies that we can diligence, and they're generally software compliance type companies. Businesses that are AI or machine learning focused, so that provide AI services into other sectors and industries, I think are quite interesting for us. Then we've got a couple of others on our short list that I'm blanking on at the moment. But I do think for us, it constantly comes back down kind of to the management teams. I would say AdTech is probably not a sector we're going to spend more money in, just because we have three really good performing strong AdTech businesses. We'd like to realize those, but they're genuinely profitable businesses, which puts us in a good place. But Martech we do continue to look at.
Good stuff. Thanks very much, David and Karen.
Hey, thank you, Karen. Thank you, David. Yeah, please, let's have a hand in the air and name, rank, and serial number.
Is there a microphone, or because I've got a cold, but I can shout?
Shout.
Okay, so I actually think there is a massive disruption coming into the VC scene. And I'm going to tell you my story this year. And in previous businesses, I've raised VC funding, so I kind of get how important you are at a certain point. So I run a games company, and this year we had a new game, so we're very much a startup, but we have a demo, we have an awesome management team, and we have developers that are ex-BAFTA award winners, and a game concept that is incredible.
So what's the name of the company, please?
It's called Reality Clash.
Okay.
It's an augmented reality campaign. And in January, we decided to go and raise $1 million to get us into the next stage. And we went on a 3-month roadmap of seeing different...
Look, I'm really sorry. Give us the question, because we need to move on.
So the question is, after going through this hell of seeing these things, someone emailed me going, have you tried an ICO? And I went, what is an ICO? I've never heard of it before, didn't understand what it was. I looked into initial coin offerings, had a term sheet from a VC, put that in the bin, and in 1 month raised $3.5 million on an ICO without any of the stress and pain that you guys were taking us through. And it was, and from an investor, they can liquidate and made money already.
Well, let's move that on. So, David, ICOs, are they putting you out of business?
No. And again, had this question on a panel the other week. I'll be slightly less controversial. I think they're going to be regulated a lot harder than they have been in the past. I think it'll be a lot harder to do what you did, and I'm not sure you'll even be able to do what you did for those companies in the future. I think that I would say this, wouldn't I, that venture capital companies choose your investor correctly, because hopefully once you get the money from them, they bring a lot more than money. They can help your business, help you build it, scale it, introductions, strategy, whatever it may be, and further funding. Because if something goes wrong, we talked about, Karen talked about down rounds, there'll be someone there with money to provide it.
There is no doubt in ICO.
Quite.
Karen, can I move on to you? Are you investing with bitcoins now, or still using cash?
Cryptocurrency I'd put aside, but
Right.
ICOs I think are something quite different. It's basically crowdfunding in a different form, but it terrifies me because it's investors who don't really know or care what the underlying asset is. They're just speculating on the kind of pop that the ICO will get initially. And I agree with Dave. I think it's going to become highly regulated. Congratulations for getting in quickly and managing to get the money, but I think it's going to become a highly regulated sector.
Absolutely, and I'll be taking some more questions at the end. But just a quick word about rabbits. From we're more focused on snakes, which are sales numbers and cracking executives, and they also eat rabbits. Now, back to the Martech conversation. Quick round of applause, please, again for David and Karen. Thank you guys very much. Thank you for Declan. So Declan Kelly from Web Summit. We've also got Charlie later on as well. There's an awful lot of Irish people here today. Never mind. Okay. Earlier this year, Moore Stephens, together with WARC, as I mentioned earlier, put together the first inaugural market sizing of the Martech space in the United States and the UK, something which we hope to build on in the future. Certainly got a very, very good reaction from media all over the world. And I'd like you to give a big hearty welcome to Amy Rogers from WARC, who's going to give you snapshots of our joint research together. Amy, thank you very much.
Okay. Right. So hi everyone. I'm Amy. I'm research editor at WARC. I don't know how many of you in here will actually be familiar with WARC. We're a publisher of content on advertising effectiveness, so that includes a massive database of case studies, best practice guides, trends, and a lot of ad spend and ad forecasting data. We're a subscription-based business, so we're used by agencies, by brands, by consultancies, and by some academics as well, and we basically just aim to help them do advertising better. My role within WARC is to kind of run our primary and partner research projects, in addition to kind of managing some benchmarking tools that we have around ad spend and ROI. And I also run our WARC 100, which is our annual ranking of advertising campaigns and agencies and advertisers. So the main reason I'm here today is to talk about the piece of research that we did with Moore Stephens. It was on the current state of the marketing technology industry in the UK and the US, and we aim to kind of predict its future growth as well. But before I talk about the research, I just wanted to kind of set the scene a little bit for why we think the Martech industry is growing so much. So it's emerged as a result of the need for real-time marketing, for the automation of marketing, for the need for real-time personalization and delivering marketing messages at scale. And it's a rapidly changing industry in terms of the tools and the channels at our disposal. It means the marketing mix, or the potential marketing mix, has the potential to be really complex. So many options available for marketers in terms of media and channels. And the Martech industry has kind of grown to improve that complexity for marketers, to try and make it simpler. Whether adding a load of new technologies onto existing ones actually ends up simplifying things is yet to be seen, but that's the aim anyway. So I've got a few slides that look at the changing state of marketing in terms of the channels used and the distribution of spend among channels at the moment. So this first chart is the global share of ad spend by media and format, and it's taken from our global ad trends data. And it shows how the media mix has changed between 2007 and 2016. As you can see, the red line at the top there, that's TV. It's remained pretty stable over that time. It's 35% in 2016. But this chart shows the rise of digital over that time. So, and that's at the expense of the print formats, so newspapers and magazines. and that teal line there is search. So that finished 2016 at 20% of ad spend globally, and with mobile display also that green line there showing a strong upturn since 2014. The next slide is that chart, but just for the UK. So again, TV's holding fairly steadily, 26% in 2016. But the difference here is the role that digital's playing. So spend on search is just 1% below TV in 2016, and spend on mobile display has hit 10%. So it just demonstrates the increasing role that digital's playing in marketing in the UK, and the picture in the US is pretty similar to that as well. So as I said before, WARC is a publisher of content about advertising effectiveness, and we hold a massive database of award-winning case studies from effectiveness competitions around the world. And I wanted to include this chart because it shows the allocation, or the average allocation of budget among those case studies. So this includes just the case studies that have budget data within the case studies, or they release their budget data. That's a base of around 700 case studies at the moment. So we can say that kind of the allocation here is reflective of really effective campaigns, because these are award-winning case studies. And here the increasing use of digital is clear. So 2016 there you've got 54% of spend on average on digital, at the expense of all other media. Now TV is decreasing there. Just a word of kind of caution on this chart. We're not looking at the kind of the death of TV or any other doom and gloom statements that are kind of put out there about TV at the moment. WARC's very much an advocate of the use of TV in the media mix, in addition to traditional media. We think its impact on long-term effectiveness is crucial, but what I'm trying to show is the increasing use of digital, and as a result the increasing need for marketing technology to manage this huge amount of digital channels and data that's coming in. So onto the research. This was the piece of research we did and we published back in September. I'm sure it's still available to download from the Moore Stephens website if any of you want to kind of download the whole thing after this, but I'm just going to go through a few of the main findings. So the survey was designed to take a look at what's going on among brands and agencies in terms of Martech in the UK and North America. And then we wanted to produce an estimation of market size and then predict its growth going forward. So we surveyed around 500 brands and agencies in both regions. We asked questions around current budgets, use of Martech tools and barriers to future growth. And then agencies asked with their kind of typical clients in mind. So as I say, I'm going to go over a few of the results. So we started by asking for the brand's total marketing budget. And then we asked this question, which was what percentage of your overall marketing budget do you typically spend on marketing technology? So this chart split between the US and the UK, and also between what they spend in-house and what they outsource to agencies. But the overall combined US and UK was that 16% of marketing budgets are spent on Martech. This chart suggests that maybe the UK are slightly more invested in Martech. That was an average of 18% compared to the US's 14%. And then the market sizing. So using that 16% of budgets that is spent on Martech, we needed to extrapolate that upwards for the whole of the US and UK markets. Obviously, we don't have marketing budgets for every company in those countries, so we used WARC's ad spend data as a proxy for those marketing budgets. But that was around 220 billion at the time when we did it. So we use that to extrapolate upwards, and we get this figure of $34.3 billion. And then of the brands that then expected their Martech budgets to rise, that averaged out at about 10%. So we come to this figure potentially next year of $36 billion being spent on Martech. Obviously, estimating market size is really difficult. We're assuming that this sample is representative of the whole market. But these figures kind of provide an indication of how strong the appetite is for Martech. And it illustrates the opportunity for tech vendors and agencies over the next year. So where's this investment being spent? We asked which of the following disciplines that they currently use the Martech tool for. They're mostly using it for email at the moment, so 85% of respondents said they had a tool for email, and a further 3% plan on using one over the next 12 months. Second to that, again, digital. 75% are using a Martech tool for social, and 7% plan to. If we look down at the bottom of the list, experience optimization, tools for that are only used by 37% currently, but that's going to see the biggest growth over the next 12 months. So 24% plan on using one over the next 12 months. And collaboration tools used by the fewest at the moment, so those are things like Slack and Trello, but by 23% plan on using them over the next year. So I've included this slide to show the size of the opportunity for vendors. Almost a third of brands, so the dark blue is the brands and the light blue is the agencies, almost a third say they don't have all the tools they need, but they are kind of utilising those they do have. And then a further 19% don't have the tools they have and don't fully utilise those that they do have. So you've got a total there of 50% who aren't fully utilising the marketing tools, need further tools. And we saw on the last slide where that investment's likely to go. And the agency response is even less convinced that their clients have the tools they need. So you can see there more than half think their clients need more tools and don't use the ones they do have properly. And then these are the barriers that brands and agencies are finding towards further investment. I'm glad that Josh put up the slide about the 5,000 vendors. That lack of understanding is the second one down there. I think that's a reflection of how many vendors are in the marketplace at the moment. Certainly investors don't understand the industry. Obviously brands and agencies don't really understand the industry either. It's something that I think a lot more learning needs to be done into over the coming years. But the top one, marketing budget constraints, that's always the top one in these kind of surveys. If we had more budget for everything would be great. But that second one down there, I think, is the key point on this slide. And then this final chart from the study, it looks at the specialist versus generalist debate. So in a market with more than 5,000 providers, there's obviously a lot of merger and acquisition activity. There are vendors that want to stand out as being independent, specialist, and there are others which have this full suite of technology that they claim that can cover all of a brand's needs. This shows that most of our brands responding use one technology provider for the majority and a specialist provider for a few others, and less than a quarter have all of their needs provided by one stack. I think it shows that either those full service big Martech enterprise providers are either too expensive for the majority, or they haven't quite yet succeeded in providing this full stack service, so people are having to use specialists to complete kind of their Martech needs. So I'm just going to finish on a few takeaways. So now brands are spending 16% of their budgets on Martech, meaning that the industry could currently be worth 34.3 billion, but half of brands don't have the Martech tools they need. Expecting it to rise by about 10% over the next 12 months, and that future will be governed by trust in the industry and understanding, as I've said, and the priority put on budgets for Martech by brands. And that's me.
Thanks very much, Amy. Time for just one or two questions before the next panel kicks in.
I do have a mic.
Oh, well done, well done. Gentleman in the middle, that's really awkward, but okay.
I think clients will confuse Google in or out of Martech as a solution.
So I think they think Google is a Martech provider.
Yes. Let's say Google Analytics Premium.
I think the more mature of the brands in there will include that in there, but there was a massive range of brands responding, so yeah, I think they would do, especially Google Analytics, because it's such a core piece of such a core tool for most brands to use. I think they would include that in Martech.
Okay, any more questions? All right, well let's move on. We're into the Martech panel now, chaired by Russ Shaw, founder of Tech London Advocates, who I mentioned before. but joined on the brand side, Caroline Macintosh. This is the time to join the panel. Caroline Macintosh. On the Martech side, from AdYouLike, we have Dale Lovell. And Nick Hirst from adam&eveDDB. Nick also took part in our webinar earlier this year on the launch of the research. So big round of applause, please, for our Martech panel. Thank you very much.
Thank you, Damien. Good afternoon. My name is Russ Shaw. I'm the founder of Tech London Advocates and Global Tech Advocates. We are private sector-led, independent, not-for-profit groups that do two things. We promote tech ecosystems and the startups and the scale-ups in those tech ecosystems, and we deal with the issues and challenges that we see out there. I set up the London group 4.5 years ago, and last week at an event I held called the Tech World Tour, we introduced 7 other sibling groups across the UK, Spain, Northern California, Singapore, the Nordics, and our most recent group, Tech Shanghai Advocates, launched last month. So that's a bit about what I do, but let me turn over to my esteemed panel. So let's just start this off by, we've heard from our analyst. We heard from 2 great investors. We just heard from Amy from the research side. And lights in your way, yes, if you want to move to one side. Does this ring true for you? You've just heard a lot of things about Martech, about ad tech. Caroline, I know you're eager to get us started. Does this ring true from what you've heard this morning as somebody who is running a brand in marketing and technology?
I think for me, one of the greatest things that you said is actually with the sort of suite of providers that we speak to is like, what do you actually do better than the man next to you? So for us, I think that was a thing that really rang true. And it's a really exciting time for us as a brand. We've completely developed our own data skill sets within the teams, and I think it's becoming much more interesting for us when we're working with our agencies to be able to have the right type of conversations and not just be the client that sort of says yes and squirrels away and then says, oh, what is the performance, to be actually able to have what do you think you're doing really well at? And what do you think you're kind of messing up with? I mean, if you can be very honest, Chatham House rules, be honest here. And the budget all today, brilliant. I think for us as an alcohol company and an FMCG group, what we really took on board about 4 years ago was we took data as a key accelerator for business growth. Yep. Dan here, who's on my team, we're not afraid to be able to talk data alongside our brands. And I think we have sort of our key pillars for the business, and one of them is digital acceleration. So how can we not build the business without understanding data and around what we do? So I think we want to enable our people, and I think that's something that we've done very, very well.
Great.
And I think, what have we done badly?
Yep.
Well, I mean, obviously the agency, nothing at all. What have we done badly? We've probably run as fast as we could and maybe not listened and maybe looked at our learnings. I think that's very much where I'm coming from. I work in the global travel business, so we do things very, very quickly, and the amount of data that's around us is huge. But do I really translate that into business deliverables, or the language that the business speaks, without going DSP, DBM, and scaring them off in the first 5 minutes? I think we've got a bit to do yet to translate that into the types of conversations our management team have.
Okay, I'm going to pass to Nick in just 1 second. Before you go, that slide that showed literally hundreds and hundreds of organizations, do you really get that? Do you understand that? Are there aspects of it that you look at and say, look, that really resonates, and there are other aspects of it that I haven't a clue?
I was a consultant before I joined Pernod Ricard, so I had my own business, so
right.
and very much kind of from a digital transformation perspective. So they brought me in, I think, for the reason that I do understand those businesses. And I also worked in brands, so I guess I could speak the language of both of them. But it's a huge opportunity. But I think very much we've got to realise, if you're selling this kind of tech in, what is the benefit for us as a business?
Great. And
what can you do to support us? So we've grown our IT solution team, tenfold, so that actually it's not just the business, the brand teams that are making the decisions, but it's also the IT teams who are now working really, really closely and also building our own proprietary platforms. So, we're were obviously wonderful. But yeah, so I'll pass on to you.
Nick, does this all ring true to you from what you've heard this morning? Does it fit with what you see? You represent lots of clients who are grappling with this.
Yes, I think it does ring true.
Okay.
I think it done. I think
quite.
certainly the level of interest and apparent importance and pace of change of it all feels true. I can't think of a client I work on things with very long, complicated purchase cycles like car businesses. We work on a lot of FMCG businesses. I can't think of a single client that isn't in some way thinking about the role at marketing technology at the broadest sense will play. Email has been around for a while, but things like AI-driven dynamic creative is something we're all talking about. We're thinking about it as a business and thinking about what our play will be. So that the fact that it's happening rings true.
Okay.
I think some of the assertions around effectiveness I'm more skeptical about. So my job is not to get excited about marketing technology. My job is to make sure my clients are making proper long-term returns, profit, not just short-term revenue, but profit. And I know from all the other research that a lot of it's on the WARC site actually. It's about getting the balance right. It's about using some of the short-term technology stuff here alongside actually things like TV, which is still a very, very powerful driver of long-term value.
And I'll ask the same question of you that I did of Caroline. What do you think you're really getting right here? What do you think you're really excelling at from the agency side? And what are you just not getting right at all? Where are you messing up?
Messing up's probably a little harsh. I think we're still in experimental and hypothesis mode.
Okay.
So I think there are certainly things that we are getting into. So I mean, things like how to do dynamic creative really well. We're probably less clever than some of the specialists out there, but we know that it's a thing that's interesting. And I think part of it's because we're not a specialist in it. We have a load of other things to think about. Part of it, I think, is we are trying to adopt a kind of healthily skeptical approach in that we're trying to work out whether this stuff really pays back in terms of not just in terms of the return, but also in terms of the effort it can often take.
Yep.
So we're possibly not as fast as we could be, but I think the benefit of that is that we're kind of watchful and skeptical a bit. I think what we're doing, I think agencies like probably most agencies are more open-minded than you perhaps. I think we probably have an image about being kind of TV dinosaurs whose vested interest is to just carry on cranking out expensive TV ads. Believe me when I say we're massively excited about all the new stuff, but I think we have to try and be responsible. We've got a reputation, I think, in the agency world, and marketing has in general, for being irresponsible and slippery with money. So we're just trying to be very careful about making sure we're doing the right things that will pay back properly.
Okay, thanks. Let's pass the mic over to Dale. Dale, I'll ask you the same question. Does this all ring true from where you sit, and you've got a brand and you've got an agency sitting to your left? Are they getting it right?
Well, I'm coming at it from a slightly different angle, I suppose, as a technology platform. So AdYouLike is a native technology platform with an AI capability kind of built in. No spreadsheets. So obviously we work across kind of agencies and brands, and we see them grappling with these challenges quite often in terms of Martech. A question for you guys actually was, do you agree with that definition of AdTech and Martech? because my business is a traditional kind of AdTech kind of platform. We make money from advertising.
So do you agree with that? Do you agree with the
I
definition?
do actually, yeah.
Okay.
Yeah. I think it's quite a good definition to see. The challenge I think that a number of brands and their agencies have is that there's, as the Lunascape kind of showed, there's so much tech on the market. When I speak to my agencies, my publishers, they're kind of inundated with technology providers kind of coming at them with different solutions. The challenge for yourselves really is kind of identifying what is and isn't valuable for your business.
Okay. Next question for each of you. Putting your own companies to one side, what particular brand or organization do you really admire that you think is getting this right, and why? Give us a specific example of what they're doing that you think demonstrates how they're really embracing this whole space.
Want to go first? A trend that we've seen kind of this year, and I think we'll see kind of going into next year, which is some of the more traditional businesses kind of moving into the technology space. You had SpotX, for example, kind of bought quite recently by a broadcaster, RTL.
Right.
I think in a lot of the presentations there, we've seen points around kind of data and
people wanting to kind of access that data. I think there's a lot of maybe more legacy style businesses that are beginning to kind of look at data and look at tech in quite an interesting way, and are making some kind of interesting moves in that space.
Okay, Caroline, what about you? Who do you admire?
I think just for me, it just depends on what scale you want on that kind of personalisation, etc., and how spooked are you on what we can actually do now with technology. And as I said, in the travel retail space, we are looking at someone who's willing to travel or is travelling. So there's a huge amount that path to purchase, as you said, is just pretty ginormous. You know, it's like from someone who's just looking at what they're doing in the travel space to actually someone who's right up next to a shop and who's going to actually buy one of our products. So I think for me, it's whichever brands are being the most relevant. And as you said, you know, we can't be away with the fantastic creative ideas that, you know, that companies are coming in. You know, we're talking today about our ecosystem, our stack, and et cetera, but what we said and we clearly outlined is that we need that really amazing creative idea. And then how does that then work against all the ad tech that we use, or the programmatic and the dynamic content, etc. So I think for me, I guess it's not just one brand, but how do people be the most relevant they can be using technology for me as a consumer, or for seeing how people can make a really amazing campaign that has really targeted the heart of that consumer. So I'm sitting next to a creative.
Okay, but hold on, before we pass the mic, any company in particular, any brand in particular? You must be looking at some others. I'm
always looking at others,
Good.
especially in drinks. I think there's too many to choose from in our
we'll
world.
Come back
but
to
yeah,
you.
we'll come back to me.
Have a think.
No
Nick,
pressure.
Who do you admire? You must see lots out there. Who do you think is really doing this well?
I'm going to be hugely partisan and say Volkswagen, with whom I work.
Okay.
Full disclosure.
Why? What are they doing?
So I think, they have a long purchase cycle, and they are using a lot of technology across the whole thing to do everything from broadcast stuff to targeting people when they're in market to managing a pretty complex database of customers. I think the thing that's so the fact that they're doing that stuff is not the impressive thing, I think, because everybody's probably doing that, and I would obviously think that Volkswagen are doing it more cleverly than most. But I think the thing that's impressive about it is that they are cool-headed about what it can all offer. So on the one, they're sort of managing to pull off this trick, I think, of balancing quite a high level of understanding of some of the tech stack that they're using, which frankly exceeds my understanding as a my background is an ad guy, you know. So, but at the same time, I think being very kind of judicious about what it can offer, and being very demanding of us as agencies to explain what it's for, and to use the same numbers to explain whether this thing is more effective than that thing, and really what the benchmarks are. So everything comes back to a purchase funnel. It's funny seeing the purchase funnel slide. I immediately started making notes, because I think it's the kind of tool that allows you to that allows you to look at this stuff through a framework that you understand, and be quite judicious, therefore, about whether it's all working for you or not, if that makes sense.
Yep, very good, thank you. Let's shift gears a bit. Let's kind of talk a little bit about the macro picture about what's going on, because all of you have to deal with your brands, your clients, your customers in that regard. You know, we have things like cyber terrorism. We have this thing called fake news. We have Brexit. We have the Trump impact on how people are viewing things. What is this doing to your businesses in terms of, you know, how consumers feel about the brands, and how does this also impact the brand's desire to learn more about customers and personalization? Because we've been talking a lot about data, the importance of data, artificial intelligence, but yet people are out there looking at these bigger issues and saying, do I really want to give this up? Look at what just happened to Uber in their announcement over the past 24 hours. 57 million records being hacked. What is that doing to your businesses? Because it all sounds wonderful, it all sounds great, but people must be thinking twice about it. Dale, let's start with you.
Well, I think this year that one of the kind of keywords, I suppose, in advertising circles has been kind of brand safety. I think before this year it was very much maybe something everyone kind of paid lip service to in many ways, whereas now it's very much a kind of front and center of the majority of campaigns. For technology businesses like ourselves, it's an opportunity as much as a challenge, in terms of the technology is in place to put in kind of safety restrictions and kind of reassure our advertisers that when they run a campaign with us, that those brand safety measures are being met. Additionally, there's companies like Moat and Integral Ad Science who are kind of set up to monitor that sort of stuff and work effectively. Platforms like ourselves kind of are integrated with Integral Ad Science, for example. So I think there's a lot of kind of reassurance that technology can play in that way to make sure that everyone's meeting the suggestions required.
Okay, Caroline, do your customers feel like they can really trust you and some of the other brands that you see, given everything that's going on in the macro environment?
As I said, in travel and alcohol brands, we have an absolute field day. So Brexit, tick. Global terrorism, tick. Coming back to over 21, over 18, that someone needs to look over 25 in an ad. We need technology to make sure that we are the most compliant that we can be. We currently work in Dubai, where obviously Facebook and and a lot of the ad providers don't want to really touch an alcohol client. So we've got to be very, very, very clear on, for example, when we're geofencing an airport to drive a new product, we have to be extremely, extremely careful and using the right data providers and using the right technology in order to make sure that we are not going over the line when it comes to, religious restrictions, when it comes to alcohol restrictions. I work in, Dan, who's here, works in the restricted markets such as Russia, UAE, etc. But we also work globally in the likes of Thailand. It's a restricted market. So we need technology to make sure that any digital advertising that we're doing is absolutely safe. We use technology to even sign off campaigns globally to make sure concept and content is right from a legal perspective. So for us, we need technology to keep, as you said, brand security, but also absolute security of our consumers in those respective markets, because alcohol advertising, as we know, is becoming more and more restricted. So for us, it's an absolute must.
Okay, I'm going to put you and Nick on the spot a little bit more. Let's go a little bit deeper on this global issue and I know, we've got Facebook in the room. We've got, we've heard a lot about Facebook, Google, Twitter, in terms of the types of things that have been going on there. How do you feel about that? I mean, we saw the charts earlier. They're growing in leaps and bounds. The revenue growth is phenomenal. What are your clients? What are you thinking about in terms of, am I really putting my money with them when there's some of this other negative stuff going on? And what pressure are you putting on them to say, hey, we can't keep going in this direction?
Sorry, do you mean specifically around the issue of brand safety and transparency of?
Yes, but also in terms of where you place your ads and things like that. I mean, we know Google and Facebook are our largest ad receivers. So how do you feel about that? What are your clients telling you when they're saying, well, look, this is my concern given what I've just seen them put out there?
I mean, clearly we don't want ads running in the wrong place. I mean, that's been. I don't think that's a problem that's new to the digital age. Frankly, there was a time when the big panic of a Monday morning might be a print ad running next to an unfavourable article. And that sort of thing still happens as well. It's just more spottable and I suppose less predictable now, less easy to spot. It almost goes without saying that that's not a good thing. But I don't think that extends to a kind of general. So Facebook and Google, with whom we partner on a lot of campaigns, Volkswagen, for example, are also tremendously useful platforms because of things like they offer things that perhaps whether it's reach, video, which is becoming bigger and bigger and also more and more powerful, and is starting to actually reach plus video, which is a way of reaching people and doing some of the kind of long-term powerful stuff that we'd like to do for our clients. Those are tremendously powerful things and not available everywhere. Okay. So I suppose our attitude to brand safety is pretty much the same as it always has been, which is let's try to avoid things like that happening. But I don't think I think we'd. I mean, if the real question is kind of are those companies a threat or is their growth somehow a threat? I mean, obviously.
No, I'm not saying are they a threat. I mean, they're here to stay. They're part of the fabric of what we're doing. But are you getting, because of this issue around how brands are feeling out there, what their customers are saying, a bit of mistrust about what's going on in the broader sphere? Are your clients saying to you, this doesn't feel quite right? Or is this feedback that you can take to them that says, how do they make sure that the landscape is a much better one than what we've heard about over the past year?
I mean, I think there's a mistrust in general, which I think we all need to work on together. I don't think it's a thing that we would take from our clients and take to Facebook or Google. It's a thing that we all collectively need to get right, which is a mistrust about, you know, whether some of these, whether clicks are real, whether some of these views are real, whether the reach numbers that we're seeing are real, all those sorts of things. I think we all need to work together to make sure those things are transparent, and that's a general, that's a problem that has been talked about before already. So we all need to kind of work on that to make sure, and that's an issue of, I think, collective responsibility and a kind of accountability when it comes to spending other people's money.
Okay, time for one question, I believe, and then I know we need to move on. Anybody have a burning question? Let me come up with the microphone. Tell us who you are, where you're from, please.
My name's Charlie Macon. I run a company called Pin Target, which is a locational advertising business. One of the things I've noted in the conversation today is there's been almost no comment or conversation about consumers. We seem to have almost, I wonder whether in marketing you may feel that we've actually lost interest in who's buying the products and become obsessed in the technology in how we deliver the messaging, because nobody has spoken about people, how people receive messages, what they're doing, how they react. And I think personally, I think it's going to be one of the failings of the industry unless we get our act together.
Great point. Who wants to take that on? Dale. Oh, sorry, Carolyn, you were going to go.
No, I think as the clue in the title with what the industry, fast-moving consumer goods, and for me, I'm really sorry that I haven't talked about my consumers, because as I said, for me, that's very much where you talked about the right message at the right time in the right moment of their path to purchase. So we only use technology to be, in our business, to be as relevant as we can. So, we want to be thinking about where are they in that path to purchase. And for me, the exciting thing about the amount of technology that's around is how relevant you can be. So I guess, spin it on its head and you're saying, what is the business case, for example, as you were saying, what's the business case for using this piece of tech, and what are we trying to achieve? And that comes very much back down to, the targeting that we use and the type of consumers that we want to do some sort of service or some sort of actionable piece. So no, consumers are at the heart of everything that we do. Technology just enables us to do it better and sometimes smarter. So
Dale, you want to add something?
So I'm a native advertiser. Our ad formats are traditionally kind of more engaging and have the consumer more at the heart of kind of what we're trying to do in terms of the look and feel of the advertisement that you engage with. Also, I suppose my customers are sitting to my left. I'm a B2B platform, so kind of chatting with these two is kind of the first and foremost part of my kind of sales pitch, I suppose, and kind of what we do.
Nick, a final comment from you before we close the panel.
That's all true. It is a good point, though. I think there's a danger. The more you talk about the how and the tech, the less time there is, frankly, to talk about consumers. It's not a foregone conclusion. I think used right, technology can, whether it's data about people and their behaviour, can tell you an awful lot about how people are behaving in the real world. Some of the most exciting things I think we're doing with both technology and the data it throws up is to understand people, sometimes to target them with broadcast campaigns, sometimes to target them with NPD, which has nothing to do with AdTech or Martech. It's just a good way of finding out about real people's lives. If we get the modes of communication right, we'll do stuff that's better for consumers. Where we get it wrong with things like following people around the internet with advertising they don't want to see for stuff they've already bought, is that's not a very consumer-centric way of doing it, and that's a poor use of technology. I think we all know that. But you raise a really, really important point. I think our desire is always to do the stuff that's right for consumers. And I think it's about using technology in the right way.
Thank you. Dale, Caroline, Nick, thank you very much. Back to you, Damien.
Thanks a lot, Ross, Dale, Nick and Caroline, thank you very much indeed. Now, today you would have been given one of these very nifty looking feedback forms. Please give us your comments from today. I'm particularly interested in this, if you go back to the strapline of this event about show me the money. Any comments you have about where stakeholders you feel the attention is going to be heading. Is that going to be artificial intelligence or even real intelligence? You've heard about the importance of brand safety, for example, and what sort of impact that's going to have for investors. Right, standing between you and your drinks and canapes, I'm delighted to welcome to the stage today the last of the Irishmen. Irish people we have for you. We bumped into each other at Mexico a couple of months ago, which was a wonderful reunion. And I was thrilled and excited to hear that Charlie is taking a much more active role in the Martech industry. So give him a big Soho welcome. Charlie Ardar from Facebook. Thank you very much.
Thanks very much. I'm just going to grab, I knew there was a glass of water hidden in here. So, hello and good afternoon. And it's a real pleasure to be here, by the way, and for, you know, at this Moore Stephens event. They're a great firm. They're a really busy firm. They know their stuff, and it's therefore great to be here supporting this day with you all. So Charlie Arda, clicker, yeah. Charlie Arda is my name. Prior to Facebook, which I joined a couple of years ago, I was a founder, entrepreneur, number of companies, a couple of successes, a few failures in Europe, in Silicon Valley. And today I lead a team that helps entrepreneurs all across Europe, the Middle East, and Africa to build, with Facebook, solutions that help primarily advertisers on our platform solve problems and get more from our platform. So the team is based all around EMEA, from Tel Aviv to Warsaw, all of the major cities. We've got people who are connected to the local startup ecosystems, the investment community, and the corporates as well, and those sort of bigger companies who we're working with. But our main kind of focus area are those early stage companies. And over the last couple of years, we've already seen a couple of these businesses go from 5 or 6 people to hundreds of people who are processing hundreds of millions of dollars of media spend on Facebook, or who are helping advertisers with their creative, or who are helping utility businesses using the Messenger platform, for example. So it's pretty varied, pretty broad canvas what we do. Try to come up with a slide to express how excited I am about, you know, as a marketer and as an advertiser, as an entrepreneur, as an investor in this space. This is where we landed. So the gif of the little boy with the garden water hose. So obviously pretty excited about the industry and where it's at today. We think that there's so much scope for innovation to create value from capital and entrepreneurs in that combination. When I talk about Facebook, I'm not just talking about the big blue, the one founded in the Harvard dorm room 2004, but the whole Facebook family of apps. So a lot of this info you may have already, but it's always a good refresher because, you know, we're kind of humbly trying to grow this business, and thankfully the numbers are testimony to the good work that the entire team does. But we are talking about over 2 billion people on Facebook, 800 million on Instagram, WhatsApp, which I'm not going to talk about today because we're really, really early figuring that out as a business, but it's a massively helpful utility to bring people together, to bring communities together, and more to connect businesses with their consumers. And Messenger, which in other parts of the world would be even more popular than WhatsApp, which we are seeing ways that are really encouraging from our point of view and from third-party developers' point of view at how businesses can connect with consumers in a sort of nicer way than calling your telephone company and waiting on hold, wondering when you're going to get an engineer to come and fix your broadband connection. So as a team, partnerships team within Facebook, we're a small but mighty team. We have our EMEA team is, like I said, we're spread out all over the place. We also have versions of this in APAC, out in Menlo Park in New York. So pretty broad coverage. We're only working though, like when I was thinking about the Lumascape and the thousands of companies on it, like we're only working with about 200 third-party developers. So we have a sort of criteria, and there are certain milestones and things companies need to do in order to get a badge from Facebook to be a certified Facebook marketing partner. Our mission is to drive end client success through third-party partnerships and technology solutions. And the rationale for that is that even though like we do have a lot of engineers, we can't do everything ourselves. So we recognize that some people do things better than we do, or we just don't have the bandwidth and the time as a relatively small company. If you compare, say, Facebook to some of our peers, they have a lot more people than we do. So we're really dependent on this ecosystem of partners to help our advertisers, of which there are many, thankfully. to make their lives better in terms of their marketing decisions, their return on investment, and hopefully to help the consumers, which have a better experience when they're on all of our family of apps. And like to the question before I came on, our number one priority is the consumer experience of our family of apps. If people aren't having a good time, then that's like the first step in the wrong direction. So what I'm going to try and do today, because we only have a short amount of time, is give some. It's not a prescription for what's definitely going to work by any means. There are thousands of things that companies could do, that people could invest in. So this is just some sort of directional tasters of some of the stuff we're thinking about, some of the stuff that we haven't been doing so much of before that we're doing more of into next year. So the three things are online to offline, so connecting those two worlds of digital marketing with the real bricks and mortar world. Scaling creative, so Nick's still here? Yeah. So really interested to get your in the bar take on what I'm going to say here. And then also messaging. So these are kind of three areas that we think there's a lot of white space, right? So opportunity. Online to offline. So like the best way of describing this is describe a journey that we would all go on as consumers. So for example, I was on my desktop. I looked at an ad came up for a pair of jeans that was probably targeted by a store that I bought off before, and I went, I'm actually looking for a pair of jeans. That's cool. Then on my way home on the tram, a newsfeed ad pops up on my mobile. They're able to then go layer deeper, and because the ad products we have enable this, so they can start surfing maybe stuff that I bought before, and then Saturday I've got a half an hour spare. I go into the store. I'm still a touchy-feely shopper. I want to try them on, despite the industry, I still like to go and downtown, maybe have a coffee. And that's the sort of journey that we go on as consumers all the time. All of these digital signals that we're seeing at work, that we're seeing on our mobiles, and then we end up in a store buying something. Mostly, the retailers have no idea how I got there or what made me make up my mind to go in and buy that pair of jeans. Unbeknownst to them, their marketing machine had been ticking away and giving me little suggestions and ideas and thinking I maybe should be buying these jeans. Maybe there's a sale on. Something prompted me. So we believe that there's a massive opportunity, and like we have companies doing this based here. There's a company called Bionic who are working with, we have an offline conversions API. So we're making the tools available to third-party developers to do this. And who've got some really good case studies with companies like JD Sports and people like that. So we think that this is a really interesting space, simply and primarily because of this stat. So over 90% of stuff that's bought is still in stores. And I think when you think about people in this industry, and like in our office, there's stuff is just constantly getting brought in, people buying stuff on ASOS or whatever. But there's actually most people in the real normal world all over the place are still going shopping, and there's a big opportunity to connect the two together. So yeah, the digital interactions are increasingly driving sales. So like, what would they be connecting it together is probably worth mentioning. So they have the retailers have point of sale data. They often have loyalty programs. They often have just email lists where people are signing up at different events or triggers. All of that data can be used if you've got the right APIs, which we do, to connect the two together to make smarter buying decisions, and to know that when somebody buys something that triggers a yes, it worked signal into the sort of media mix. So the next area that it's all good. That we think is a big area of opportunity, and this does touch on AI and all the kind of the how-to, but this is more like a kind of an industry inflection point. I think is what's happening. So we really do believe that because of the shift in medium. So in other words, if you think about and the WARC data earlier on was still showing that television is this consistent high value channel or in terms of spend. But Facebook, even in the last couple of years, has evolved so many different ad formats, and the user base has grown so dramatically that we now believe that creatives are now sort of scratching their heads a little bit, as we talked about earlier, saying, how are we going to develop ads to work in all of these different formats, to take advantage of all the different targeting options? There's no longer one or a half a dozen audiences to think about. There's thousands because of all the targeting options that are available. There's no longer, print, banner ads, TV, radio, outdoor. There are tens of different options of ways to show up on the small screen in front of consumers. So the creative is changing, how stories are told is changing, and how these stories are put together and crafted has changed. But maybe the solution has been we need 50 or 100 videos. Maybe let's bring in more freelancers, or let's test some. And there are already some technologies that are out there, or video libraries and things like that people are using. But we think that there's way more scope to grow here to help these agencies, because the creative industry, this is our take, is really happy about this generally, right? Because this is more ways to tell brand stories. There's more like Nick was saying. There's a lot more video products out there that you can really do a story justice now, and you can really like plan a sequence of videos and connect with consumers, and based on how they watched the previous video and things like that. But so this is like an opportunity to make some more money from the client point of view, but they're happy because they're getting more out of the whole relationship. But there is frustration, and I mean that's because a lot of this has happened really quickly, and that there seems to be every Monday morning somebody knocking on the door in the agency saying, we've got this new thing, we've got this new thing, we've got this new thing to help you solve these problems. And generally, we believe that this inflection point means that the creative industry is not, and there are some more ahead than others. It isn't all Don Draper sitting around drinking bourbon coming up with a killer line for the TV commercial. I mean, we know that. But there is a sense that, there's a lot of change happening here, and it's kind of got a bit out of control. So with that change, we believe brings opportunity. So we're already, so this is just an example of the products, different kind of products that we've got that all require different kind of creative. So we're already seeing companies, I'll just talk about the ones here in London because that's where we are, but like Vidsy, which has a young company that's bringing together an entire network of creators. So avoiding this need to hire, expensive freelancers, you can tap into this thousands of freelancers essentially via one platform. PhotoAspire, another company, and these are early stage companies that have raised maybe a million-ish or maybe a bit more. I don't know the exact numbers, but they're early stage businesses who are having phenomenal success with world-class brands at adapting to these new formats. Crucially, they're not going direct to brands. They're working with the agencies, and these new cohort of companies is the new tool set for the agencies, because we believe agencies still are that deep sense of what the brand owners want. They've been with them maybe for years. They understand the KPIs of the business. So this isn't about like agencies are the new travel agents, but absolutely not. This is about agencies need a new toolkit, and we believe that there's a huge scope for investors and entrepreneurs to get involved in making that toolkit for this shift that has happened in terms of the medium. There's something happened there I missed. So finally, messaging. So like I said, who likes ringing the phone company when the line goes down? Like nobody. Who likes standing in line at an airport to change your boarding pass or change your seat? Nobody. So one area we think, I've skipped it. We think there's a lot of scope for Messenger is customer care, and I'll get back to that now in a second. Generally, some stats on Messenger are that there's 70 million businesses, 20 million are actually already from their Facebook page, primarily messaging their customers. So there's we rolled out this really easy way for businesses to send and receive messages to customers. 2 billion messages, that's including auto-generated messages, but it's still real traffic between people and businesses. And we've 200,000 bot developers. Now, admittedly, we launched this platform in April 2016, so a lot of these bots are not that great, but we're learning, and we are seeing some really great stuff emerging. And one of the great applications, and one that is probably applicable to the startup community, because it's that kind of B2B Martech kind of space, is this area of customer care. So one really good example of that I'm going to show you is KLM. So KLM built a bot using the Messenger platform that automated the check-in process and automated just generic queries about, like, is my flight on time? Can I have my boarding pass? To the extent that there's 15% of all boarding passes now are sent via a bot. This is in the space of about 9 or 12 months, I think. Customers are happy, and there's a 40% increase in customer interaction since the bot was launched. So we've got companies like iAdvise in France, Service Friend based in Tel Aviv, who have got serious momentum in this space, but we believe there's a lot more scope for new entrants. There are so many utility companies, airlines, and other applications that could, coffee shops, restaurants, that could take advantage of this. And the real thing that's really attractive, and I started off life in a telecoms company, is the sort of direct, really fast impact this has on your EBITDA, because it's all just reducing your call center operating costs, and it's just dropping straight to the bottom line, because the cost of running these is actually quite low. But you're able to take a lot of these sort of frequently asked questions, or kind of pretty mundane things that don't really require a human to schedule somebody to call out, or tell the customer to reboot their modem. All these things can be done with an AI and with a bot. So there's just a really clear financial benefit. When we were talking earlier about just talk about the benefit to the customer, and we'll get to the AI bit. It's a really easy to articulate. And we think there's a lot of scope for verticalized versions of these, because all these industries have their own nuances and differences. It won't be here's a company that does bots for customer care, it'll do everything. It won't work out like that. How these are being put together, without getting into it, is, and I kind of touched on it earlier, is AI is at the center, but it's really, really early. With AI, generally, there's a huge amount of capital and energy and investment going into it, but it's going to take a long time to be what we think it might be in a sort of sci-fi movie. So what's happening is a lot of those mundane, repeatable tasks and questions are being handled by the AI, and then the AI knows if it gets too tricky, it's out of its depth, it just sends it over to a human. Human hopefully fixes the problem, and the customer's happy. So you've got these hybrid bot AI, or hybrid bots that sort of give all the sort of repeatable, easy to do stuff to the AI, and then still hand over and work with humans. So we think this is a really interesting area on a vertical by vertical basis. So yeah, so just want to, finally, the message that we want to say today is, there have been a lot of graphs earlier on about the big companies doing well, but we are still a small company, relatively speaking. There are many advertisers, many problems, and that's why we're investing in our partnerships team. The team has grown a lot in the last couple of years, and we're open to talk to whiteboard ideas, to come up with and consult with entrepreneurs who have ideas, and sanity check things with investors if they're thinking of looking at these ideas. So we're very open to business. We want to build with people, and we're not this sort of faceless dot in a graph. We want to work with everybody we can. So that's it. Thank you very much.
Okay, thank you, Charlie. I believe Charlie will be taking questions in the bar and not in this forum for a number of reasons. Thank you also, Charlie, for the PowerPoint lesson. That's how to do it, right? That's how to do it. Good man. Okay, I think one of the looking at who are the winners and losers. I mean, I've written down for myself here that, and based upon something Charlie just illustrated with the KLM case study, but also mentioned by Amy in her fine presentation on the WARC research, that I think winners are going to be the technology companies who put customers first. To my friend's early question about consumers as well, and maybe the same answer applies. The opposite answer applies to the losers. But let's hear from you. Hand in the air. Either wait for the microphone or don't. But let's hear what you think about today, and who you think the winners are going to be in this space, in the digital media space in 2018. Anybody want to have a go? Anybody want to have a start? Or do you all want to go to the bar? I'm completely easy either way. Okay, well I think it's going to go to the bar, but I want to thank Josh Sambrook-Smith from Saracens, Declan Kelly, David Fisher, Karen McCormick, Amy, Rogers, Russ, Dale, Nick, Caroline, and last but not least Charlie, and to you all, thank you very, very much indeed for coming. This is the beginning of a conversation, the beginning of a discussion, and with Moore Stephens we're very, very pleased to be exploring this space, and it really is great to get this feedback and to get you all here today. So thanks again. Thank you. Just finally to the team at Moore Stephens, led by Alexa, did a super job, Alexa. Thank you so much indeed. And to Natalie, Danielle, and everybody else that's helped out. Much appreciated. Thank you again.